The Christmas and New Year holiday spirit is gradually fading, but no one is ready to let go of their belief in a magical miracles just yet. The roller coaster ride the euro took earlier this week is a vivid confirmation of that. As soon as markets caught even the slightest hint of a shift in Donald Trump's stance on tariffs with the European Union, the euro-dollar pair made a sharp reversal. Such market moves serve as a rehearsal for what lies ahead for traders in 2025. There is no doubt that markets will continue to react to the mood swings of the US president and the new threats, calls he decided to announce or deny. In other words, volatility will accompany financial markets on a regular basis. Does this mean the euro's jump will be the last this year? Unfortunately, as the world awaits Donald Trump's inauguration, the forex market should brace for the euro-dollar parity. Some analysts warn the two leading global currencies could reach equal value as early as January. The primary reason for the euro's decline will be speculation around trade tariffs, but rather the differences between the United States and the Eurozone economies. As a result, the widening gap between the interest rates of the two central banks will drive this trend. Yesterday's report showed that the number of job openings in the United States unexpectedly increased in November, while the layoff rate remained low. At the same time, business activity in the services sector perked up in December. Besides, commodity price indicators reached a two-year high. This data should be seen as a signal of rising inflation and potential shift in the Fed Reserve stance toward higher interest rates. As a result, the US dollar index is still trading at about 108.50, not far from its two-year high reached last week. At the same time, the euro has retreated to its two-year low. However, stronger than expected inflation data in the Eurozone lifted the single currency to 1.0422. Nevertheless, it had to bear the brunt of a report showing a sharp slowdown in the German manufacturing sector. Instead of the anticipated growth on months, the indicator dropped by nearly 7%. As a result, even optimistic retail sales data failed to inspire the euro or sustain its upward movement. For now, the bull's inability to break above 1.0375 can be seen as an excuse for selling. A break below the technical line at 1.0335 will extend the pair's correction toward the support zone of 1.0298 to 1.0285. And this area marks the trend border, making its potential buying point. At the same time, it's important to understand that without tepid US macroeconomic data and simultaneous improvement in the Eurozone, traders should abandon hopes for reversing in the euro's decline. The final verdict for the euro may come as soon as tomorrow, following the release of the US ADP employment report for December. For more details on the timing of this and other economic data, as well as their potential market impact, check out our traders calendar. Interestingly, oil prices today ignored the rise in the US dollar and hit the highest level since October. Brent crude climbed above $77 per barrel, holding gains within the range of 77.20 to 77.90, what boosted a rally in the oil market. Oil prices kicked into gear following reports of a sharp drop in the US inventories. According to the American Petroleum Institute, reserves fell by 4 million barrels last week, while forecasts had predicted a decline of around 0.25 million barrels. Additionally, colder weather in the United States and Europe has increased fuel demand. Amid rising oil prices since the start of the week, the Russian currency has managed to regain its footing. The Chinese yuan remained virtually unchanged during yesterday morning trading on the Moscow exchange, while stock movements showed mixed signals. The ruble is trading quietly in the domestic currency market as trading volumes are low due to a public holiday in Russia. The dollar-ruble pair is trading between 104 and 107.20. However, concerns over new anti-Russian sanctions and the uncertain situation in the global equity markets are preventing clearer signals for a trajectory in either direction. That's all for today. We monitor developments in the financial markets, subscribe to our channel, and stay up to date with the latest news with us. See you online soon!